Hello everyone. Listen to this episode. Most likely, no financial coach would have given you this perspective about your money. But just a standard disclaimer, as always, that this video should not be treated as substitute of a professional personal financial advice which differs person to person. My simple question, when we take a loan from the bank or when we give a loan to the bank, in both cases, why does only the bank decides the rate of interest? Whether they are a lender or a borrower, they have the right to fix the rate of interest and not us. When you go to a bank to borrow any kind of loan, or even when the bank itself contacts you and offers you a loan, then as a borrower, you do not have the authority to decide the interest you will pay on that loan. The bank decides how much interest you need to pay on the money you're borrowing because they are the lenders, right? And when you give a loan to the bank, or you're wondering, when do you give a loan to the bank, isn't it? Yeah, in commonly used term, that loan you give is called fixed deposits. That's correct. FD is just a loan you are giving to the bank to run their lending business of giving loans to someone else at a higher rate. So when you give this loan to the bank, then you are the lender, but still you don't have the authority to decide how much interest the bank as the borrower should pay you. In both cases, the banks only decide the interest rate. Is this fair? On top of this, they also deduct tax in advance on the interest income every year, irrespective of whether you actually withdraw that interest amount or not. Are you required to deduct TDS on interest you pay to the bank on loan borrowed from them? No. So this advance tax in form of the TDS is another form of loan which now the government takes from you to manage their activities. They keep it till you claim the refund following year after filing the tax return. Then it is up to the government when to process that return and when to refund your money. There's no specific timeline to it. As a finance guys, these are common sense for me, and all these are major disasters from a cash flow perspective. So I do not hold any fixed deposit in the bank. Instead, I would either keep the money in debt mutual fund if it is for short term, or will buy the bank itself if it is for long term. Yes, buy the bank. If you're looking to park your money in FDs for little longer term, say over 2-3 years, then buy the shares of the bank you like. You will make much more money and pay much lesser tax. Look at this data for last 10 years as of 31st March 2023. The blue bars here show you the value of 1 lakh deposited in FDs of these banks on 1st April 2013, and the red bars show you the value of 1 lakh worth of shares of these bank purchased on 1st April 2013, the same date. Rupees 1 lakh deposited on 1st April 2013 in any bank would have been around 2 to 2.1 lakh. It works out as 7.6% per annum on an average. And this is before considering tax and inflation, after which any FD return is usually negative. But if you purchase rupees 1 lakh worth of shares of say HDFC Bank on 1st April 2013, it would have been rupees 5.15 lakh by now, and that too at much lower tax rate. This works to be a CAGR of 17.81% per annum. Note, there was no long-term capital gain on equity till 31st Jan 2018, and after that too, long-term capital gain up to 1 lakh per year is exempted from any tax, and after that you pay only 10% flat rate on long-term capital gain. So the tax impact is very low. Even if you consider an average inflation of 6% per year, you have positive returns of around 12% on the shares. On top of this, you get dividend income which a company pays out from time to time, and of course there is no TDS. As on 31st March 2022, 52% of India's personal savings were lying in these bank deposits. Imagine if a portion of these would have been used to buy the shares of these banks, Nifty and Sensex would have been at much higher level. Understand the difference. When you do a FD with a bank, you only have a right to the bank decided low rate of interest which is fully taxable. When you buy shares of the same bank, you get the right to share in the profits and market value of that bank as an owner of that bank. Now you decide which one is better. We put in a lot of thoughts, time, and energy in creating this video. So if you're finding this useful, please do share with others too, and do subscribe to our YouTube channel. And if you want to learn more about personal finance, join our Money Masterclass WhatsApp group by sending a text to this particular message, to this particular number. Sorry. Thank you.